Hello, Smart Money Tree podcast listeners. Welcome to this week's show. My name is Kirk Chisholm, and I will be your host. So this week, I'm joined with my favorite guest from California. Well, I shouldn't say that because Megan's there too. I can't say favorite. One of my favorite co-hosts is Barbara Friedberg. Hey, Barb.
Hey, Kirk. Nice to be here.
Well, glad to have you on this week. I know we're changing up a little bit, but certainly it's always a pleasure to have this with you. And now I have to ask, what do you want to talk about this week, Barb? We have a laundry list of things to talk about, and there's so much. Where do you want to start? I'm going to let you start since I don't want to do
I
all
want
the
to
fun
talk with
today.
about FTX. That
Let's do
is
it.
the huge cryptocurrency platform by Bankman-Fried, star
Sam.
30-year-old entrepreneur, which has fallen bankrupt. And what happened? Were you caught up in this? And how to make sure that you don't get caught up in this type of morass in the future?
Yeah, that's a good question. So let's dive right in, and I'm going to try to pull up some images here because I found some interesting ones. But yeah, I mean this is FTX, which if you guys haven't been following it, I don't want to say you're living in a cave, but it's been the top story for quite some time now. And I've said this on the last one or two shows that I touched on it. I wanted to touch on it and just really let people know it was happening, but I didn't want to get into it too much because there's this concept of what we call fog of war, which is once a new story comes out. I don't care if you're a Democrat or Republican, independent, I don't care what your political affiliation is. Everything we see now is pretty much fake news. You could claim your side's correct and the other side isn't. I don't know what's correct anymore because it's all BS. People are trying to clickbait you. So what tends to happen, and this isn't anything new, this part, but when a news story comes out, the news organizations are desperate to get it out quicker than the other person or the competitor. That's been the way for 100 years. Is they're always trying to be first. And I can't blame them, it's their job, right? But when you get it out first, it doesn't necessarily mean you're right, right? You hear a story and you just get it out there, let everybody know, and then it turns out to be totally incorrect. Well, nowadays they don't even bother retracting things because, whatever. They might retract it on page 100, but the point is they're getting it out there. So we have this concept we call fog of war, which is when it first comes out, you don't know what's right. It's interesting enough that you're paying attention, but you shouldn't draw conclusions from an initial news story because most likely things are going to change. And like I said, it's whether it's the side you believe in or not. You should just take this into your mental calculus that if you hear something, just take a pause and say, all right, I'm going to wait to see how this develops. And granted, this has generally developed the way that it was initially called, but it's still really early. So, and Barb can correct me if I'm wrong because things change so frequently with this story. But as of right now, I believe they've filed for bankruptcy, correct?
Correct.
Okay, and they're going through the bankruptcy process, which is how some of this information is coming out, which it has been kind of interesting. Um, but I think a lot of I will call it fringe stories, which we don't know if they're true or not, claiming that they're a secret funder of the Democratic Party or, they're buying off all the politicians. Honestly, all that stuff, maybe it's true, maybe it's not. Still too early to tell. And frankly, even if it does come out, nobody's going to care because it'll come out 6 months from now and it'll be old news. That seems to be the status quo with news releases nowadays. Is they put all the garbage up front, and then when they find out it's incorrect, it's 6 months later, and nobody cares anymore. So that should also take into your mental calculus when you're looking at news. But Barb, I know you've read a lot about this. What are some of your thoughts about this? Just kind of how people should be thinking about it, what they should be looking for, and does this have any other implications for other things?
Yes, yes, and yes. Okay, so Sam Bankman-Fried was originally thought of as this brilliant genius. He was one of the faces of the crypto industry, amassed $1 billion fortune before the age of 30. So he was backed by really elite investors, BlackRock, Sequoia Capital, one of the biggest exchanges in the world. But let's get under the skin, under the hood a bit. So FTX is domiciled in the Bahamas, and their laws are much laxer. They're much more relaxed. So there wasn't the kind of oversight that you get with a company that's domiciled in the US. And not only is FTX his only company, he's got other companies. He had a big hedge fund, and he has actually, how many companies was it?
Four
Was
big
it?
ones.
Yeah, he has 130 sister companies. Okay. And so let's look at what caused this first. And then we're going to delve into, hopefully you aren't a customer, because the future of getting your cash back is kind of gloomy now. But if you're not, or if you are, we're also going to talk about how to avoid getting into a situation with a company that's going to take your money in the future. So what Sam did was he took billions of dollars of customer assets from FTX, and he used them in his primary hedge fund, the Alameda, to fund their investments, which didn't work out. That caused a red flag. Additionally, investors started trying to pull their money out. They were stopped because there wasn't enough money for all the investors who wanted to pull their money out. Currently, FTX is under investigation by the Department of Justice, the Securities and Exchange Commission. All withdrawals are being halted. And so if you're an investor, and a lot of really smart people were investors, are kind of screwed now. You can't get your money out. You don't know what's going to happen. Clearly, Sam Bankman-Fried's going down for something. We don't
Hopefully.
know. We
If
don't
he's
know.
connected with all the right politicians, he may not, Barb. I mean, we've
Yeah,
seen that
well,
before.
I do appreciate your skepticism and caution regarding the systems that run our economy. Clearly, we don't know how things will play out. But what we do know is this is a cautionary tale. And it's the real takeaway, Kirk, is when you invest in something, number one, know what you're investing in, know what the risks are. Always look at the worst case scenario. And that means the possibility of losing 100% of your investment. And literally, that can happen even if you invest in a publicly traded stock. I lost 75% in a company that I bought a couple of years ago, affiliated with the crypto industry, when crypto tanked. But I knew that was a possibility. I didn't invest a lot of money in that stock. And so I sold it, took the loss, and realized that was a possibility. So it didn't disrupt any of my overall investing plans. So, Kirk, is that a good background for us?
Yeah, I think that's a good start, Barb. And I think, to touch on some of the points you made, I think some things to take away from this are, um, you know, well, a few things. First is, don't put all your eggs in one basket, right? Unless it's your basket, right? If it's your company and your 90% of your wealth is tied up in your company, that's okay. It's your company, right? It's your fault if it goes down, and you get all the credit if it goes up. So anybody who has that structure, I'm not going to, I think people who tell you to diversify just want your money, frankly. I think it's great. I mean, I see this with advisors all the time. Oh yeah, you should sell some of your shares so you can go buy our stuff and we can get paid. No, that's just, I mean, that's silly. If it's your company and you know it inside and out, it's why invest in some other company that you don't have the same insight and advantages to. Now, granted, if your company stinks, then yeah, maybe you want to diversify. But if it's your company, you're running it, you're in control, then there's no reason to sell, right? So first, I want to say that there are people, you hear these celebrities, I think, like Steph Curry and Tom Brady and Giselle, are shareholders or investors into FTX. I frankly don't know. I haven't looked into this. I don't know their status, if they bought into the company or they promoted it and got a percentage as a promotion, and rather than getting paid, they got a percentage. If that's the case, but they were saying right now, I saw last night that there is a lawsuit naming those three in the lawsuit, in addition to Sam. So they were putting them in there. I'm not sure if that's going to hold water or not. Typically, lawsuits do not take shareholders and pull them up in front of the court and blame them too. That is the whole point of a company and having shareholders, is that they have no liability beyond their own investment. So I don't know where that goes. I'd be curious to see if there's anything beyond that. But I think all this gets into the fog of war stuff. Like, when you see these headlines, most of it's crap. They just want to get your attention. So I would be hard pressed to see that Tom Brady and Giselle and Steph Curry are going to be up there with Sam on the stand, getting grilled as to their involvement when they're shareholders. If it was more than that, then maybe there is. But like I said, I don't have enough knowledge to make that claim. I'm just kind of giving you some insight into how to think about things, because we don't have all the data. But the other thing I want to point out is that there have been a few studies, and I'm going to have to pull one of these up, and I'm going to, if I find it, I'm going to put it on the Wednesday episode on the website when it goes up. Is that it's really easy to get duped by fraud. Okay, I'm just going to put it out there. It's really easy, and there's a study out there which shows that the smarter you are, the more likely you are to get duped by fraud. Now, think about that for a moment. The smarter you are, the more likely you are to get duped. Now, why do you think that's the case, Barb? I'll just throw it out to you.
I think because you think you're too smart and you think you can look at all the angles and figure it out. Now, Kirk, I'm going to be transparent here. I've never heard that, but so I don't know if it's right or it's not. Look, I trust you. And, even if it is wrong, literally look at the Bernie Madoff scandal and look at all of the really smart people that got duped. And I think what this is telling you is, first of all, just don't do the FOMO thing. My brother-in-law's into it. This guy's on TV and is into it. They recommended it on CNBC, so I don't have to do my homework. You have to go into any investment with a cautious investigative mindset. And you have to think about what's the underpinning of the investment? What am I investing in? Okay. And how is this company, investment, crypto exchange, how do they make money? And are they going to be able to keep making money? Now, whether this was in the fine print, I haven't read the fine print of FTX. In the US, as we all know, Kirk, with regulations out the yin yang, you have to list everything in the SEC documents. So I'm kind of a nerd in that way. I look at those SEC documents. I look at the prospectus. I read the fine print. Not if I'm going to invest maybe a few dollars that I don't really care about, but if I'm going to make any type of meaningful investment, then you want to know exactly what the risks are. And in a US investment, they have to spell it out. It's in a big place in the CRV, the SEC 10Ks, 10Qs, all these gobbledygook of letters, prospectus. They have to say what the risks are. And so you need to read that if you're going to put more than a couple of bucks in any investment.
Yeah,
right?
and I think,
Right, Kirk?
I think quite frankly, when you look at those disclosures, if you actually read them, and I think I forget who it was, somebody, that might have been Peloton, or I might be misquoting this, so apologies if I'm getting this wrong, but I think it was Peloton where they were in the risks. Or I forget what it was. It was in the prospectus, but it said, "What do you do?" And it said, "We bring joy to the world." There was something along those lines. It was so vague and fluffy that I had this sent to me by like 10 of my friends and said, "Wow, this is their business plan. We're gonna joy to the world.
Do you
Start
invest in
laughing.
a company whose mission and growth plan is to bring joy to the world? I'd take that money and give it to UNICEF or the Red Cross because I think they're going to bring a lot more joy to the world than Peloton is.
Yeah, I mean, granted, it might bring joy to your life. Maybe not the same kind of joy. I'm not sure I'm joyous when I'm riding on my bike. But I guess the point is to what Barb was saying. You really need to read. Really need to do your research. I think that to getting back to that study, which I'm going to have to find it and point it out. I know I've read it like 10 different places, so I know it exists. But the point is that when you see other people investing, most people get to the FOMO. Well, Tom Brady's in it. Really? Is how successful has Tom Brady been with his portfolio? Is he better than Warren Buffett? Is he better than Carl Icahn? Like, I don't know. I have no idea what he's doing. Maybe he's wicked, as they say in Boston, wicked smart, or maybe he's really the opposite. I don't know, right? I have no idea. But I know that I'm not gonna trust the judgment of celebrities and athletes for my investment decisions. That's not really the best strategy, but yet people do it every day, right? It's the
I would
FOMO, as
take
Barb
a
said.
fantasy football pick from Tom Brady. Okay,
I would agree with
I
that.
would
I
trust
think
him
he's
for that.
he
I think
might have
he's
some
got a
insight I don't have.
yeah, he's got a better chance of picking a good fantasy football team than I do.
Agree.
But as an investor, you know, where did he get his CFA or his CPA or his you know, finance degree?
Yeah, so I think getting back to what Barbara's saying, I think that's the first thing is the FOMO. It's really important is don't look at who's investing in it. And here's the reason. Somebody told me this a few years ago, and I love it because it's so perfect. So the way research is done on Wall Street is like this. So let's say you go to a cocktail party, right? Well, let me let me start this again. One person on Wall Street is doing the research. So there's somebody in a back room reading all the reports, doing all the work, and they're doing a great job. And then his buddy knows this guy. So he's like, well, this guy's really smart. So I'm just taking his word for it because I know he's done the research. And then some guy knows that guy, says, oh, I know this guy who's really good, who knows this guy. And then there's some other woman who's like, hey, I know this guy who knows a guy who knows a guy. And then everybody else who hears it, they hear it at a cocktail party. That's how Wall Street research is done. There's so few people doing the actual research. It's just not something that is done religiously. Bernie Madoff's a perfect example. You had Harry Markopolos yelling from the rooftops, this is a fraud for years, to the SEC, to all his buddies, everyone's like, I don't see it. This other guy's invested in it. It must be okay. I hear that constantly. And to make it even more funny, because I was talking to somebody this weekend at the conference that if you guys are in the Insiders Club, you would have heard about this. If you're not in the Insiders Club, please sign up. Just go to the website and there's just put in your email and you'll get access to the Insiders Club, and actually will give you some free money. But I was at this conference and I was talking to this guy who runs a hedge fund, really, really smart guy. And he was like, oh, well, there, with the crypto implosion. And I was asking him a question, like, what do you think of this ETF closed-end fund for crypto? And he's like, I don't like how, other people, I forget what he said. He said something along the lines of, but other people see it this way. And then he went on to say how that's not such a good idea. I'm like, isn't that what you're doing? Like we all do it. It's common. It's just we all want to fit in. We all want to back ourselves with somebody else's research because we have our own conclusions. We're like, well, this person, Warren Buffett said it's okay. It must be okay. Well, I don't know. Maybe Warren Buffett has a different agenda. I mean, this happens all the time. George Soros tries to get out of position, so he tells everybody that he wants to buy it, so everyone else buys it. Now he's got people to sell to, right? So many things happen on Wall Street that are beyond your comprehension. That you're not there to know the details. So you can't listen to other people ever. I mean, even me. I mean, that's why I don't sit here and tell you what to think. I'm not here saying you need to buy like Jim Cramer does. I'm not saying that for a very specific reason because it's silly. Because even if I think something, if I tell you this and you're going to go do it and you're going to come back and say that was wrong, and I'll say, well, yeah, it was right, and then I sold it 5 days later and made a profit. People don't tell you when to buy and sell. They just tell you one side of it. So don't listen to anybody. Do your own research. That's one of the things we say on the show week after week after week is do your own research. Now, I'm going to get back to that study because it's really important. Is the reason, one of the reasons, there's many reasons this happens, but if you think of the cognitive biases, one of the reasons this happens with smart people is they know they're smart. People who are not so smart or average intelligence, they all think they're smart. People who are smart, they know, they don't think they're smart. They know they're smart. And so they think that their intelligence will get them through life without any bumps and bruises. We all have the same cognitive biases. It's not an intelligence problem. It's a human problem. Cognitive biases are how we're all wired. So because you're smart, it doesn't mean you're not human. It doesn't mean that you're better than your baser instincts. We all have that problem. You have to really work hard, and it's not an intellectual thing if you're able to get around them. And there's ways to do that, but it has nothing to do with intelligence. So people who are smart, they tend to be a little bit it's a little bit harder for them because they know that they're smart. So they tend to take it easy on some things, say, oh, I know that, I know this. But, there's a guy we brought on, his name escapes me right now. We brought on a due diligence expert on the show, and I had a lot of positive feedback, so we're going to put him in the show notes. But, here's a guy who does this for a living, and he's like, we make mistakes all the time. He's like, we're really good at what we do, but it's so easy to make mistakes. I mean, we look at this stuff for clients all the time. And I have to tell clients, look, there's a good part of this that we're not going to have visibility into. I'm not going to know if this guy has a good credit rating or not because I have to ask him to run a credit check in order to get that, right? I don't know if he's got, he's got outstanding loans and he owes his ex-wives alimony, child support. I don't know any of that, right? I don't know if this guy's, sending money to the Communist Party in China. I don't know, right? You have no insight to like 50% of what's going on in that person's life. All you have insight into is that entity. And this actually is a plug for this. If people don't know, highly recommend if you're getting investments, make sure that they have a third-party due diligence firm doing this work, because no matter what you're doing, it's not going to be enough. I'll just tell you that it's not going to be enough. You're always taking a chance with entities and investments. Get a third-party due.
I also want you to talk about external custody. Touch on that too.
We can get into that in a minute. I do want to get into this one point though, is that this getting a third-party due diligence firm, it's not like a credit rating agency, right? You think of all the stuff that happened in 2008 where the people who are getting rated were paying the credit rating agency. Like, oh, there's no problems here. Nothing to see here. No, everything's good. No, this is what they're basically buying is AAA rated credit. And they're saying, well, if you don't give me AAA rated credit, I'm going to go across the street and they'll give it to me. I mean, you saw it in the movie The Big Short. This is different. There are a handful of firms out there. And if you don't, if you want to know who they are, go to ADISA, ADISA. There's an organization that deals with alternative investments, and there's a few firms there. I think there's 2 or 3 firms that do this, and they have a lot of liability, so they're not screwing around. This isn't like a credit rating agency. These are like serious, like personal liability if you screw up. And what they do is, if you have a fund and you want to sell it to investors and you wanted to get this third-party due diligence, you have to pay them like 50 to 100 grand to get due diligence on your fund, and that is not even knowing what the outcome is going to be. You might not even, they could come back with a really crappy due diligence on, crappy meaning like it doesn't make you look good. You could pay that money and they'll say, yeah, sorry, this is what we see. It doesn't look good. They're not going to butter you up for that. They're literally, you pay it up front and you get what you get. These are the firms you want doing due diligence on these funds, because they're going to go through everything with a fine-tooth comb, background checks, credit checks, and they're going to go through your underwear drawer. I mean, they're going to get everything. You're not going to be able to hide much from these people. So that's what you want to see. They're going to do a much better job than you or I, because they literally have 20 people on staff to go through all of this. And, most people just don't have that kind of background. that kind of sense of how to do it, and frankly time. So, you wanted me to touch on something else, Barb? Sorry, you. Um,
Yeah, I want to talk about when you hire an investment manager, third party custody, because that was a big problem with Bernie Madoff. So, touch on
right.
that for our listeners so they understand they need to know who the custody agent is with whomever is holding their money.
All right. So we had a friend of ours come on the show a while ago, Kelly Coughlin, and he talked about, because he has a background in this, and he talked about TLC. You need to have TLC with your investments, and that's transparency, liquidity, and custody. And transparency is having full transparency into where things are. Anybody who says, "Oh, it's a black box," run. Black boxes, I get the concept. They don't want to share their IP with you. But if somebody says it's a black box, run. Some of the best money managers in the world are transparent. So why shouldn't everybody else be? Now, if it's somebody like Jim Simons, who had this really secretive way to create like 30% returns a year in, year out, and it's done through some really interesting stuff. Okay, I mean, you have to take a chance there, frankly, know the guy or have some insight, because I wouldn't do that if I didn't know the guy. It's just too risky. So transparency is really important. Liquidity, it needs to be a liquid investment. And if you can't pull your money out for 10 years, then good luck. Hopefully you don't need that money in 10 years. So personally, I like liquidity. If you're going to have an illiquid investment, make sure it's going to give you something that you're not getting elsewhere. Like if you're buying real estate, and real estate is, for all intents and purposes, illiquid, even though you could probably buy and sell it quickly. It's technically illiquid because it takes a long time to sell, and it's not something you can just click a button and sell. So, but because it's illiquid, you have an illiquidity margin of difference or premium or discount, right? So right now, if it's it's not a buyer's market, but if it was a buyer's market or a seller's market, and they could command whatever they want, then you have to pay up for that. You have to pay more. But if it's a buyer's market, which means the sellers can't sell and there's not enough buyers, then you could command a discount to what you could get it less, right? But if you need to sell today, you're not getting a premium. That's the point of liquidity. Is liquidity gives you instant access to sell it. But if you can't sell, what if you can't sell it, right? What if it takes you a year to sell? Custody, as Barb said, what's really important about custody is understanding where the custody is. This is what's happening with some of these crypto exchanges. Is not only custody, because if exchange goes down, and this has not been a secret, by the way. If people have said this for the last 5 years, if you're trading crypto and you're keeping your crypto on an exchange and an exchange goes down, you could lose it all. Mt. Gox was the first one, and that should have taught everybody a lesson. Is that went down and people lost, I don't know everything, but a lot of it. So if you hold your crypto on exchange, you're susceptible to that exchange going down and you losing everything. Doesn't mean you will, but you have to acknowledge that as the risk, and it's probably going to be the case in this situation. You also have to worry about the fact that it could be, hypothecated or rehypothecated against some other asset. What does that mean? That means that they have an asset that you've put there, right? Just think of a bank. I'll use a bank as an example. Let's say I put $10,000 in a bank. They take that 10,000 and they lend it out to somebody else. Okay, they don't have that 10,000. They have a loan that is an asset to cover that 10,000, so it's equal. Although technically in a bank they'll leverage, but we'll keep it simple. It's equal. So technically they're the same amount of assets. But if I want to take out that 10,000 in cash, I can't, because they can't give me 10,000 in cash. That's the problem, right? Now banks have been structured in such a way so they can get that liquidity, and they've but if every single basically what would happen is if Barb's a bank and I give Barb $10 million, or let's say I give her $1 million and 10 other people give her $1 million, and all of a sudden we feel like Barb is maybe doing something that we don't like, or let's just say we don't trust the banking system. Doesn't matter, right? We all pull out our $1 million. Now Barb has nothing. Now if Barb has lent that money or done other things with it, now she's bankrupt because she can't give us the money, but it's our money to take and we can't get it. So effectively, she's insolvent. And this is why the Federal Reserve is backing the banks and the FDIC. So this allows people to have trust in the banks so they don't pull all their money out. And this is what happened in the bank run in the Great Depression, is everybody pulled their money and the banks, a lot of them closed. So the point is in exchanges, it's very similar. It's very similar in what some of these exchanges were doing, is they were lending out this crypto to other people, which is kind of like broker dealer, right? Is they take assets and they lend it to other people. But the problem is when you don't have a regulated institution and a way to back up those assets like banks do, like the FDIC. If the crypto exchanges had, or actually broker dealers have SIPC, and that's a similar thing as FDIC. So if these exchanges had that, then people would have more confidence. They wouldn't be pulling the money out and the exchanges wouldn't implode. So the biggest challenge we have right now from FTX is we don't know where all the bodies are, right? Not everybody's come out with, oh, by the way, I have a hole in my balance sheet and I have to go fill it with something. So we don't know if this is the end or if there's more dominoes to fall from this. That's one problem. And the whole industry is sitting on pins and needles waiting for the next, exchange or entity to say, sorry, we're illiquid too because we had 90% of our stuff in FTX. So we haven't seen all that. So people are still kind of waiting for that. That's a real big issue. Is what is that contagion risk for everybody? And so until the crypto industry or blockchain industry fixes that problem, which they'll either have to do themselves or have regulators do it for them, this is going to be just like the bank runs in the Great Depression. It's going to be the same thing until they come up with some what do they call it with banks, Barb? Is it moral obligation or what's it called? It's basically the I don't know. It's Friday. I'm brain dead. I've been traveling all week, but anyway, I don't want to talk the whole time. I give Barb some time here. but
I like listening to you, Kirk. I'm happy just to sit here and hear your thoughts. Usually when we go on the podcast and do the panel portion, you're quiet. We don't get to know what's going on in that really smart mind of yours.
Well, thank you, Barb. And that's why we do these Friday episodes, so I can talk more. You've been telling me this for months. You're like, you got to start talking more. I'm like, I want to hear you guys talk. It's not all about me. People get sick of me after a while, but no.
Nobody gets sick of you, Kirk.
My wife
Maybe your
might.
kids,
My kids might.
Okay. Your wife.
My dog might.
I can't speak to them, but.
So anyway, any final thoughts on this, Barb?
Yeah, I've got
some other topics.
2 final thoughts, and then I want to get to housing because I think this is another really key topic now. Final thoughts are blockchain is here to stay. Blockchain is a marvelous technology that is currently already revamping so many systems within our financial economy, within commerce, within just our entire, lives. Blockchain has an impact in many different ways. Crypto is still finding its legs. It's not a currency because who the hell is going to use crypto for money when it has such an unstable value? The dollar, it goes up and down, but not like crypto. I mean, like one day it's not going to be worth $1 and the next day it's going to be worth 25 cents. So crypto right now is not a currency. It's not a hedge against falling stock prices. We've seen it fall exactly in the same way that stock prices have fallen in 2022. And it's not secure. You can lose it. So right now, I'm not saying invest or don't invest in crypto. Just be aware of its limitations. It hasn't been really, it's very speculative, and it hasn't been defined for real public consumption yet.
This is a public service announcement. Hi, my name is Kirk Chisholm, and I'm with the government, and I'm here to help. Doesn't that sound reassuring? Well, let's talk about how they're helping. The government needs your help to make our money worthless again. PPP loans, student loan forgiveness, helicopter money. Let's keep the party going until our money is totally worthless. Don't think it can happen? Sure it can. Just ask Zimbabwe, Venezuela, Greece, Germany, Hungary, Greece, Yugoslavia. Did I say Greece? As a loyal listener to their show, I want to give you free money. I'm giving away free money in one of these hyperinflationary currencies. Go to www.moneytreepodcast.com/free money and follow the instructions to get your free gift. I have a large audience and only a limited supply of these currencies. I'm not the Federal Reserve, so I will run out at some point. Make sure you get yours before I run out. Go to moneytreepodcast.com/free money. Follow the instructions and get your free money today.
So that's all I got on crypto for now. Do you want to go into housing?
Yeah, let's do that. So I'm going to share, if I can ever figure out how to do this, I'm going to share a, here we go. This is what we call the magazine indicator. And here it is. All right, share it here. Okay, so this is what we call the magazine indicator. And frequently you see in certain magazines, mostly it's non-financial magazines when they get into like, you know, some sort of a Newsweek or USA Today or some non-financial publication. When you see something like this, it's probably time to be a contrarian. So, you know, if I saw this in like, you know, Newsweek, I would say, all right, now it's time to buy crypto. Not for any other reason other than the fact that by the time it gets to mainstream media, this is when it's a good time to do it, because they're usually late. And it's usually because everyone is on, if you think about like sentiment, right, with any sort of investment, sometimes sentiment's on one side, sometimes the other side, sometimes it's in the extreme, so way on one side. When that happens, it's usually time to fade it, which means now you start going the other way. So fading it would be, oh, like right now it would be buying crypto, even though it's scary, right? That's fading it. Or when everyone is talking about how you know, fintech or the financials are just going to rule the world, now it's time to sell, right? Like that's the magazine indicators we talk about. So I just wanted to share that because I saw that and I just started laughing. I'm like, oh, it's probably close time to buy. So, you know, getting back to the picture that I did want to show, I want to show a few pictures here because I think it's really important. So we're talking about homes and housing, which seems to be kind of a regular thing every single week. And it is because it needs to be. It is such an underappreciated issue right now. Let's see if I can do this. I don't know why it's doing this to me. It's really buggy. Okay, so this is home buyer traffic. Now, if you look at this, you'll notice that there are times where home buyer traffic is really low and there are times it's really high. So for the last 2 years, it's been pretty high from historical standards. Right now, it's extremely low. It could go lower, which it probably will, but it's really low. And the reason I bring this up is because it comes back to this point I talk about again and again and again. And I do it because you need to really understand this. I talk to people every day who understand my thesis, my wife being one of them, and they understand this thesis. And at the same time, it's not sinking in. You know, they're saying, oh, yeah, I hear what you're saying. So, yeah, I was looking at this house to buy. I'm like, you're not hearing me. And, you know, it's not just my wife. I say that in jest, but there's a lot of people who are doing this. So I say this because of this. The reason that home builder and home buyer traffic is low is because it's really expensive. Home prices have not come down very much, but the affordability is a lot lower. We talked about this in the show before. It's 50% lower. So whatever you could afford last year, you can afford half as much. And home prices haven't moved. I don't know why they haven't moved because as you can tell from this, no one's buying. Well, there's a reason no one's buying, because they can't afford it. Unless you're coming in with all cash, you cannot afford to buy a home for twice the monthly payments at this price. So you have this discrepancy between people who want to sell at a price. Let's call it $1 million. Let's say get $1 million home. They want to sell at $1 million because that's their retirement plan. I talk to people every day. My house is my retirement plan. Well, good luck retiring, because that is not a good retirement plan. So you have that $1 million home that you're relying on for retirement. You don't want to sell it for 800,000 or 7 or 6 or 5, because you have your target set on $1 million. Oh, no one's buying? Well, how about 900? Oh, no one's buying? I'll just rent it. But it's worth $1 million. Okay. So many people, we've seen the other stats, is like the inventory in the market is just, people are taking their homes out because nobody's buying. So this is how many people are actually looking to buy. The traffic's down huge. And I point this out because people don't really see this yet. It takes so long for home prices to find an equilibrium. This has been as you can tell from this has been a really sharp move. We had 0% interest rates or 2% 30-year mortgages. Now there's 7. That's a huge jump in a matter of, it happened in about 8 months, I think, 7-8 months. That's huge. That's an enormous jump. And home prices have not they move slowly. 5% of the homes buy and sell in any given year. So, 2005 was the peak. 2008 was the trough. That's when the when home building, well, everything, the housing industry went and imploded. It was 3 years later. And we only eked up a little bit each year, maybe a few percentage points over that period from 2005, 2008. This is enormous. So I'm not shocked that things haven't gotten worse in the real estate market, but only because I know that not everybody's selling. I saw, as soon as rates started to go up, I saw home for sale placards all over the place where I live. It was like people were waiting for that last nickel. Like, oh, I'm going to get a little extra. And they got greedy, and a lot of them are still sitting there with their home thing on the lawn. But it's just because people, they're going to sell it if they can get enough money. And quite frankly, Barb, you have to teach me how to do this. I sold all my real estate and I'm renting, and I love it because I have no exposure to this. I want to sell other people's homes, not as a realtor. I want to get a percentage. I want to get a difference. I want to get a spread on this. Can I short your home, Barb, and then buy it back at a later time? Is that possible? I think that would be a great idea.
I'd short my own home right now.
I'll make you a deal, Barb. If you let me sell your home today, I will rent it back to you and pay you those premiums over the next few years, and then you can buy it back from me about 5 years from now. How does that sound?
I'm not thinking that's going to work out for me. I love you, Kirk, but not that much.
Maybe we should start doing this. We should start walking around to people and say, "Here's the deal. I'm gonna sell your house today. You're gonna sell it today to somebody else, and then I'll pay you the interest, and then you can buy it back from me 5 years later." I wonder if we'll get any takers. I really do. I mean, it sounds so ridiculous, but people don't think that way.
You and I both have somewhat of an economics background. And so this gets back to the basic supply and demand. Okay. At the peak of that graph in, like, I don't know, I can't see, around 2020.
2020, yes, in the fall.
Yeah, there was close to like 2% mortgage rates, which is crazy historically low. Never been that low in like probably 100 years. And so the demand was huge because money was so cheap. And because the demand was so great, bidders were buying up houses like crazy. Prices were driven up to the stratosphere. That's what happens with a limited supply and excess demand. What happened? Within 1 year, money got really expensive. Okay, so now you've got to pay 7% for a home mortgage versus 2.5% a year ago. So that boosts the price of that same house at that high 2020 price a lot, 20, 30, 40%. You can't afford that. Most people can't afford that. Most people don't have cash. So what are you going to do? You're not going to buy it now. You're going to wait for the supply and demand to come more to an equilibrium. And in order for that to happen, prices are going to have to fall on real estate. At this interest rate, they're going to have to fall. So homeowners, prospective homeowners, can afford to buy a house. So that's why people aren't buying now. And Kirk, I got to hand it to you. You sold at near a peak. You're renting now. Very smart. When home prices start to decline, and they will, then there's going to be more inventory. People are going to be able to afford it again, afford buying a house again, because regardless of where mortgage rates are, at least the prices won't be so high. So that will cut down your overall cost to buy a home. But what do you do now? Let's say you are a guy or gal and you really need or want to buy a house. We've got some options for you if you're in that position, if you don't want to rent, or renting in the area that you're in is just crazy, or for whatever reason, you can't find a rental that fits your family. It's not to say you can't buy now. There's some options. Interest rates are going to probably, if you believe the Fed funds chief, interest rates are going to go up for the next year or so. But if we get inflation under control, which that's the goal, that's why interest rates are rising, to stop people from spending so much and hopefully to bring down inflation rates. If that happens, then at some point, interest rates will tend to go back down. And then mortgage rates will tend to go back down. But back to my idea, what if you've got to buy now? Or you really want to buy now? All is not lost. You can take out a loan now with the idea that you're going to refinance later. You can get an adjustable.
Why do you have to buy now? Why would anybody have to buy
I
now?
don't know. Now, that's a good question, but I mean, there's obviously some people that feel they may have to buy now. Maybe you've got 7 kids and you can't find a renter that can fit all the kids in the house. I don't know. I don't know why you have to buy now, but
it's a
maybe
terrible time to buy.
It is a terrible time to buy. But what if you really, really want a house? Maybe you're having a baby and you don't want to continue to rent and you want to start building up equity. I mean, some people are going to buy. They're going to want to buy, right?
I know people that bought recently. I think and they acknowledged it was ridiculous. I think here's the thing to take away from this. My speculation that rates are going to keep going up, as Barb said, whether you believe the Fed chair or not, I don't believe the Fed ever, but I think they're correct in this, is that rates are going to keep going up. And, I think that's the reality. It's the rates are going to keep going up. But let's say we're wrong. That's not even why we're saying this. We're not even saying because we think rates are going up. The reason we're saying it is there's a disequilibrium between price and affordability. Now, normally, let's say, I don't know, let's say before 2020, before things went nuts, right? 2019, there was an equilibrium. Let's say the home was worth, I don't know, 700,000, and whatever the rate was, I don't know, let's say 3.5%, right? You could have got a 3.5% $700,000 home. There was an equilibrium there, right? However, what happened was rates went down, right, which is good, and then the home prices went up, which is normal. So there was whatever it was, there was an equilibrium. However, what's happened in the last 9 months, or a year, I guess at this point, what's happened is you've gone from 2%, wherever the equilibrium was. All right, so it's 2%, and you got $1 million home. But now that 2%, 7.5%, which means the $1 million home is really worth $500,000 to reach that equilibrium. It's not even like whether it's worth that. It's just to find an equilibrium because of what was existing at the time. And it doesn't have to be the right equilibrium. It could be rates go down. It doesn't What I'm saying is you have to find that balance where the rates and the affordability have a balance, which is what everybody can afford. And you know that because it like sits there for a while and it doesn't move too rapidly like we are now. That equilibrium is what's important, because if you're buying now, you're basically paying twice the cost of owning a home. It's ridiculous. And this is the part that people don't realize is this is why you don't buy a home now. It has nothing to do with the fact that rates are going up or down. If I'm buying a home and I'm going to own it forever, what do I care what I pay for a price? If it's a legacy home that I'm going to pass to my kids and grandkids on the beach or something, who cares what I pay, right? I pay what I pay. But at that point, you should be paying cash. The point I'm making is we got a little out of control because of the high prices and low rates, and things should never have gotten that high. They got way out of control, and now there has to find an equilibrium again. Until we find that, it doesn't make sense to buy a home. Now, if it was me, I would say, hey, let's wait till real estate prices come way down and rates are high, and then when rates start to go lower, so the affordability goes up, and now is a great time to buy because you can afford a lot more than what the house is worth. So it works both ways. Right now, it's completely in the seller's favor. You want to be a seller. You do not want to be a buyer in this market. There'll be a time where you want to be a buyer. We're not at that point. We have about 5 minutes, Barb. You want to make a final comment and then want to touch on a few other things?
Yeah, just the fair value of your house literally is what someone is willing to pay for it. So that's it. That's the market value. You can say your house was worth $1 million last year, but if no one's willing to pay $1 million this year, it's not worth $1 million. So I'm going to disagree with Kirk for a moment, like I love to do, and just say, look, if you want to buy a house, you can buy one now. It may not be the best choice financially, but you can even take out a mortgage now and just refinance later with the hope or expectation that mortgage rates will go down. No guarantee that that will happen. You could actually pay up points now for a lower rate. So it's your choice. Clearly, we are on the same page that with rates at this level, prices are going to have to go down because there's not enough buyers that can afford to buy a house at this price. So back to you. I will see you guys another time. I'm Barbara Friedberg. You can find me on YouTube at Robo Advisor Pros, on Money Tree Investing Podcast, and at Barbara Friedberg Personal Finance website.
Great. Well, Barb, thanks for coming on the show. Always love you having here. That's the thing we really like about this show is we don't always agree, but we can disagree with each other without being disagreeable. And I think that's the nature of good debate, and it's something we don't see in our culture these days. And it would be nice to bring that back. So we're starting a trend right here, Barb. That's the show for this week. Thank you again for joining us on Money Tree Investing Podcast. My name is Kirk Chisholm, Wealth Manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on this show. You can also check out our show at Money Tree Investing Podcast. On our website, you'll have access to the show notes, resources, and the archive shows. Please remember to subscribe on our YouTube channel for immediate access to the new shows when they're released. When you subscribe to the show, it allows us to get access to some of the top minds of investing in personal finance. While you're here, please leave a comment and question if you want us to address it on the show. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.